Welcome to Sos Talks Money on Valuetainment Economics. I'm your host, Adam Sosnick, and I'm here to help you build your wealth and save that money. On today's episode, it's all about investing that money. Let's talk money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.
All right, so let me ask you, when I bring up the word the stock market, what comes to mind? Like, what's going on in your head right now? I just brought up the word the stock market. What's going through your head? Are you seeing bulls? You're seeing bears? You're seeing ups? You're seeing downs? You're seeing lefts and rights and greens and reds? What's going on in your head right now? You're seeing the Wolf of Wall Street? You're seeing the trading room floors? What's going on in your head? So let me tell you something. Most people I ask this question see exactly that. But here's the deal. That is not what investing is today. So in today's episode, we're going to break down three things: what investing was, what it is now, and what you can do to be a good investor. All right, now let's get into the stock market today. Now, pre-pandemic, the stock market was at all-time highs, going great, everything's awesome. Next thing you know, COVID happens, plummeting, the world's ending, the stock market's going crazy, sell, sell, sell. Now what's going on now? The stock market all of a sudden, 4 or 5 months later, is exactly at the same point it was pre-COVID, or pretty close. So what's going on? Let's get into this, all right? So everyone thinks when the market's plummeting, the sky is falling, sell, sell, sell. We've learned some lessons, y'all. Buy and hold, that's a strategy you need to be paying attention to. So before we get into what was going on then and what's going on now, let's talk a couple different facts about the stock market, some numbers if you will. So number one, the stock market is the greatest wealth creator and money-making machine man has ever known. So just if you did not know that, now you know. Number two, what is investing? Investing is pretty simple. 2 ingredients to investing. You got time and compound interest. That's it. Time and compound interest equals investing. Number 3, let's get into the numbers. Now, if we're talking historical rate of returns, historical, right? The stock market will return a 10% rate of return year over year over time. That's not accounting for inflation. If you want to account for inflation, which is a real thing, y'all, the average ROI is 7.5%. So inflation's a real thing. So that's the historical rate of returns on the stock market. So here's the last thing you need to know about the stock market. The stock market is always going up, but sometimes it goes down. You see what I did there? It's always going up, but sometimes it goes down. So what you have behind me is a very rudimentary stock market chart. I tried to draw it out. I'm not an artist, please forgive me. But let's just break down what this means. I just said that the stock market is always going up, but sometimes it goes down. So let's break this down. So if you look year over year, every year, this is the stock market for the last 100 years. 1920, you can see right here, to 2020. 100 years, we just talked about that over the last 100 years, the stock market has returned somewhere between 7.5% and 10% rate of return factoring inflation. So what does this chart actually represent? Now, if you draw out the stock market year to year, it's kind of like a crazy person. It's going up, it's going down, it's going left, it's going right, it's up, it's up, it's up. But take a look at this. If I can draw a line, if you weed out all the drama for your mama right here, there's a line just consistently going up. So let's take that into account. The stock market is always going up, but sometimes it's going down. So understand that the big picture, it's always going up. So now, let's take it to the tape. So if you've seen my episodes before, I'm all about the tail of the tape, where I break down 2 different options of the same category. So what we're gonna do now is this. We're gonna break down what investing was then, back in the day, we're talking 1990, roughly 30 years ago, versus today, now 2020 and beyond. So why did I pick 1990? I picked 1990 for a couple different reasons. So number one, for most of us who are millennials and Gen Z, we were young kids, or we weren't even born yet in 1990. We were just kind of understanding what was going on in the world. Meanwhile, the stock market was on fire. The 1980s were roaring. It just turned 1990. There was a stock market crash in 1987. Now you got a floodgate of new people entering the stock market. It was absolute pandemonium. So enter the first topic, which is perception versus reality. When I asked you the question at the beginning, you probably thought of the scenes that were going on in the Wall Street movies back in the day. Trading room floors, high action-packed, dudes in suits on phones, going crazy, buy, sell, left, right, oh my God, it's going crazy. That is not what investing is today. Today's investing is all about Main Street. It's all about Main Street, all about you. You're on Main Street. That's who I'm talking to. You could even be investing from your home in your pajamas these days on your computer. Not a big deal. So back in the day, it was all about Wall Street and chaos. Today, it's all about Main Street and you as the individual investor. Now moving on to the next topic, let's talk about the public figures when it came to the stock market. So back in the day, who were the public figures? The public figures were all freaking movie characters. You had this guy, Gordon Gekko. He was in the movie Wall Street. His famous quote was, "Greed is good."
Greed is right. Greed works.
I'm not so sure about that. How do you feel about greed is good? Then you had these guys in the movie Boiler Room. You had Vin Diesel, Ben Affleck, and the famous quote from this boiler room operation was, "You think money can't buy you happiness? Well, look at the and smile on my face."
They say money can't buy happiness. Look at the smile on my face. Ear to ear, baby. Yeah!
Those guys all ended up in jail. And then third and not least, you have this guy, Jordan Belfort, who was the Wolf of Wall Street. We've all seen the movie. Crazy guy, liked to party, drugs, chaos, fun.
Was all this legal? Absolutely not. We were making more money than we knew what to do with.
But let me tell you something about that guy. And all these guys, actually. Would I party with these guys? Sure. Would I have a drink with these guys? Of course. Would I travel and have a great time with these guys? No problem. Would I invest my money with these people? Hell no. You got to be out of your mind. So understand that investing back in the day was exciting. It was fun. It was completely chaos. But that's not what investing is. So now let's get into the public figures today. The public figures today are all investors and they're boring, beautiful billionaires. Who am I talking about here? So the poster child for investing today is none other than the greatest investor of all time, Mr. Warren Buffett. Mr. Warren Buffett's favorite quote is, "The best investment that you can possibly make is in what? Is in what? Is in you." Yeah, you.
And you're your own biggest asset by far.
What did he also say? The next best investment you can possibly make is betting on the U.S. economy. Since 19 whatever, the U.S. economy has gone up, 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 up. World wars, chaos, 9/11, even with the coronavirus, we're reaching all-time highs in the stock market. Bet on yourself and don't bet against America. The next public figure that I definitely got to give a shout out to is Mr. Jack Bogle. Jack Bogle was the founder of Vanguard. Vanguard is the largest mutual fund company in the world, all right? Rest in peace, Jack Bogle. He just died not too long ago. He was in his 90s. But what he did for the common investor was astronomical. He said, enough of the chaos, enough of the Wall Street. Let's keep it simple, let's keep it effective, and let's even the playing field for all investors. His most famous quote was this: "When I die," and he just recently died, "when I die, my one wish is to keep my reputation intact." Think about that. His one wish was to keep his reputation intact. We're talking about him today as a legendary investor. Meanwhile, you got all these other movie characters who ended up in jail. So those were the public figures when it came to investing. Now let's talk about strategy. Back in the day, it was all about active trading. What's active trading? You buy, you sell, you buy. You're buying individual stocks. You got hot tips. We're making moves. We're this, we're that. This is very complicated stuff, where in fact, only 20% of active traders actually beat the market. So now let's talk about the flip side. Today, it's all about passive investing. Now, what's passive investing? You've heard this term before. You've heard of index investing. You've heard of simplified investing. Well, in fact, 80% of the time, just buying the market, the S&P 500, 80% of the time, you will beat the market. So what do I mean by this with strategy? Sometimes less is more. So if active traders who are doing this day in and day out only beat the market 20% of the time, but passive investors who just take the long-term approach, keep it simple, buy an S&P 500 index fund, play the long game, end up winning 80% of the time. So understand that. That's the 80-20 rule with investing. Now let's talk time frame. Back in the day, it was all about days, day trading, active trading. You're making moves every single day. Now, with passive investing, it's all about decades, long-term approach, days versus decades. Decades over days. So here's the example with this. It's not about timing the market, trying to time the market. Can't do that. It's about time in the market. You understand the difference? Decades over days and time in the market over trying to time the market. All right, so now here's a couple quick stats for you when it comes to day trading. Now, day trading is very complicated. It's not easy. It's very tough stuff. Here's a couple quick facts for you. So over a year, only 5% of day traders are profitable. 5%. And over the course of 2 years, 80% completely stop trying to be a day trader. So when you're talking decades, it's all about a long-term strategy. You set it and forget it and let your money ride long-term. Moving right along. Now let's get into the human element. Back in the day, you were literally dealing with a human most of the time, and it was a stockbroker. He'd be talking on his old school brick phone, the Zach Morris phone, if you're familiar with that. And you'd be talking to this guy who's a very personal relationship, but also a very emotional relationship. What do you think we should do? Should we buy? Should we sell? I got a hot tip for you. Should we do it? Should we not? You should invest. Understand something. With that relationship, it's very emotional, and when it comes to investing, the last thing you need to be doing is playing on your emotions. Now, it's all about robo-advisors. Now you're not even dealing with humans anymore. You're dealing with robots. You're dealing with tech. You're dealing with digital. You can buy things at a click of a mouse. You can customize your portfolio. It's very simple. It's very easy. And the fees are actually extremely low. Now let's get into the fees. So back in the day, the fees were pretty damn high. And why were the fees so high? Because you had to go through a broker. There were no online exchanges. You couldn't just get onto your computer and get onto a discount broker online account. You had to go through a broker. The broker would charge you every time you made a move or every time you made a trade. A lot of times they were $50 a trade, or they would charge you 1 to 2% AUM, which is assets under management. The fees were very high. Now, the fees, much like Flow Rider, they low. We're getting low with the fees now. Why are the fees so low? Well, you got free trades, you got discount brokerages. So now you got groups like Vanguard, Fidelity, E-Trade, Robinhood, Betterment, Wealthfront, and Acorns, whose fees are very low. The average robo-advisor's fees are 0.2%. Now compare that to what the fees are back in the day, 1 to 2%. Now you understand why these stockbrokers were rolling in the dough. I know it's very over-dramatized, but this is why they were doing cocaine lunches and strippers in the trading room floor. It was a lot of chaos, a lot of fun, and it was all with your fees. Now, the only stripping that's going on today are these stripped down fees of these robo-advisors. You see what I did there? But understand this, costs matter and you keep them low. Moving right along, let's talk about taxes. Everybody's favorite subject in the world is taxes, right? Am I right? No, wrong, but we gotta address taxes. Understand something, that when it comes to taxes back in the day, short term, anything less than a year that you're buying and trading less than a year is taxed at what? Ordinary income, which can be as high as 20, 30, 40% in some cases. But if you buy and hold and you keep an asset for longer than a year, here's the trick. Now you're paying capital gains tax, which is basically half the amount. So maybe you're talking 10, 15%. So taxes do matter. Now understand that these are things you can control. The fees you're paying and the taxes that you're paying are things that are within your control. Understand that. Moving right along, let's talk about retirement. Retirement back in the day was all about having a pension. You work for a company for 40 years, you retire, you get a gold watch. They pay you until you're dead. That's a pension. These days, do you have a pension? Comment below if you've even heard about a pension. Pensions barely exist anymore. I think less than 5% of the population has a pension. These days, it's all about that 401k or that IRA. If you're not familiar with these things, get yourself familiar with them, all right? These are retirement plans that you need to understand. Let's talk about something else. Social Security. Back in the day, and our grandparents today and our parents today, they can rely on Social Security. That's gonna be there for them. For us, you see a big question mark next to Social Security. What they're saying is Social Security will be there, but maybe at half the amount that what people get today. So the average amount of Social Security today is about $1,800 a month. So that's cut in half. Talk about $900 a month. Can you survive on $900 a month? I don't think so. So understand that you need to invest in your 401k. You need to invest in an IRA. And my favorite thing that you can invest in is called a Roth IRA. Look them up. These are helpful retirement tools for you to retire comfortably with. Last but not least, there's something called target date funds. If you're like, dude, I don't even know about a 401k, I don't know about an IRA, you can look into something called a target date fund, which basically says, I want to retire in 2050. And they'll just set you up a plan with these robo-advisors for you to retire in 30 plus years. So it's a lot easier today, but it's a lot harder because there's no pension and it's on you. So now let's talk about who's winning from all this. Well, back in the day, you know who was winning? Well, big corporate greed. You're talking stockbrokers, you're talking bankers, you're talking traders. It was the billionaire boys club who benefited from all this. Now, what do I mean? Only 20% of US adults were investing in the stock market in 1990. So now let's talk about today. Who's winning today? Well, it's you, the individual investor. Yes, you. You are able to capitalize on basically what's happened in the stock market today, where in fact now 55% of US adults are investing in the stock market. Now, if you're not one of those 55%, well, wake up, y'all. You got to get involved in the stock market. This is the only way for you to build wealth long term. Saving is great, but investing is better. So understand that what also is winning is equality, and fair ground is winning. Why is that? Well, 58% of men are investors, but not so bad, 52% of women are investing. So shout out to the females out there who are investing. Last but not least, you know who is also winning? The environment. So now there's something called sustainable investing, where you can invest in companies that care about the environment. Check that out. So what's the big payoff here? Now, back in the day, it was all about the bling bling and materialism. We've all seen the Corvettes and the Lamborghinis and the yachts and the Wolf of Wall Street and the party and the excess and the consumerism. So what did that all lead to? Well, it led to a lot of debt. So what's my advice to you? Stop buying things and start buying experiences. Start buying experiences, things that you want to do, things that you're dying to do, places you want to go. Everything you want to do, that's all about experiences. That's all about financial freedom. It's not about buying things. It's about buying experiences these days. So that, my friends, was the tale of the tape between investing then versus investing now. Big difference, as you can see. So now my question for you is, are you ready to be an investor? I hope you answered yes. Now, before I started investing, I read this book called The Boglehead's Guide to Investing by none other than Jack Bogle, the founder of Vanguard, who we mentioned earlier. And they basically started with this. They were basically like, they kind of hyped it up. They were like, are you ready to invest? Are you ready to invest? Well, before you invest, you need to do these three things. I was like, oh, damn, I was ready to invest. What are these three things? So understand that you need to do these three things before you invest. Number one is you need to have a game plan for your money. What does that mean? You need to have a budget. A budget is a game plan for your money. The most important part about a budget is this. It's understanding that it's all about your net worth mentality and not a paycheck mentality. That's a game plan for your money. Number two, he says the best investment you can possibly make is actually the opposite. It's actually paying off your debt. If you got high interest credit card loans, high interest auto loans, loans as high as 10, 12, 15%, or even more, well, you need to pay that off before you start investing. Why? Because on average, investing returns 8 to 10%, and you're paying 12, 15, 20%. You got to get out of debt before you become an investor. And number three, before you become an investor, is you need to become a saver. You need to save that money. Because if you don't have money to invest, or a cushion, God forbid, you don't want to tap into your investments. So those are the three things that you need to do before you become an investor. So now if you've done those three things, congratulations, now it's time to invest. So step one with investing is you need to sign up. You need to get in the game, all right? So you basically need to sign up, open up an account, and link your checking account. That's number one. Number two, you got to understand, are you doing a 401k? Are you doing an IRA? Are you doing a Roth IRA? What's your account going to be? That's number two. Number three, something called asset allocation or your asset mix. Now, what does this mean? Here's a quick finance lesson. You really got three options. You got cash, you got stocks, and you got bonds. So cash you're saving that money. Now with your asset allocation, you got stocks and you got bonds. Now what are stocks? What are bonds? Stocks are basically shares of a company, and bonds are basically IOUs where you're lending a company money. So here's my quick little advice for you on this. If you're young, if you're in your 20s and your 30s and you're watching this video, you should be at least 80% in stocks, 20% in bonds. To flip that on the other side, if you're old, if you're an 80-year-old somehow watching this video, you should be in 80% bonds, 20% stocks. So a lot of times they say you should have your age in stocks or bonds, right? So you understand that? That's your asset allocation mix. Understand that is essential when it comes to investing. So to follow up with that, number four is called risk tolerance. This is all about managing risk, because obviously on one side you got risk and on the other side you got reward. So what's your risk tolerance? Are you ready to risk it all? To put all your money in? Or you're saying, you know what, I don't want to risk it all, but I'm willing to take some risk. Or you're basically saying, I don't want to take any risk. So understand your risk tolerance. Next thing, moving right along, number five, diversification. It's basically saying, as they've always said, don't put all your eggs in one basket. So the number here is 500. 500 stocks, that's the S&P 500. It's not 20, it's not 30, it's not 50, it's 100. It's 500 of the largest stocks in the S&P 500. That is diversifying. So if one company does well and one company doesn't do well and one goes up and one goes down, doesn't matter. You get 500, that's diversification. And number 6, you gotta just rebalance and track. Rebalance and track. Basically your 80-20 mix or your 20-80 mix. Are you at 70-30 now? Are you at 60-40? Are you at 50-50? Every year at the end of the year, just rebalance, get it back to neutral, and track your performance. You don't need to do this every single day with passive investing. Just track your performance by the end of the year. And last but not least, you need to tune out the noise. There's a lot of opinions out there, a lot of TV shows, a lot of magazines, a lot of newspapers, a lot of articles telling you you gotta do this, you gotta do that. You need to tune out the noise. Now, I don't know if you're a sports fan, but every Sunday before the NFL, they're all picking games. All these sports professionals, ex-NFL players, actual professionals, they're picking their teams. And what happens? Half the time they're right, half the time they're wrong. That's the same thing with stock investing. Half the time they're right, half the time they're wrong. Tune out the noise and just play the long-term game to investing. All right, so now it's time for my final takeaways. So check it. When it comes to investing, investing should actually be boring. You want excitement? Here's what you should get excited about. Get excited about your career. Get excited about your job. Get excited about your future and the opportunities that investing will create down the road. That's what you should get excited about, not investing. So back in the day, in the 80s and 90s, it was all materialistic, and they had lived by a motto that was this: he who dies with the most toys wins. Now, what does that mean to you? To me, that means buying a lot of stuff, buying a lot of toys, which, as we know, leads to debt. So now these days, there was actually an article in the Washington Post that said this: he who dies with the most toys now loses. I was like, oh, damn, now loses? What does that mean? It means this. The new game plan is this: he or she, because ladies invest too, as we know, he or she who lives with the lowest overhead and the highest flexibility now wins. What does that mean again? It's not about materialism. It's not about things. It's all about experiences and financial freedom. And that's the bottom line. Now, if you have not seen my video on how to win the money game, that's right here. And also, if you have not seen my video on 10 things that are killing your wealth, that's right here. And if you like what we're doing here at Valuetainment Economics, go ahead and subscribe right there and smash that like button while you're at it. So, here's my final piece of advice. What you do with your money is up to you. But if you're gonna invest, hopefully you follow these 3 rules. Number 1, you keep it simple. Number 2, you keep your costs low. And number 3, you stay the course. And as always, save that money.
All we talk is money. All we talk is money. All we talk is money. All we talk is money.